Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
Good morning.
Today, we're going to be examining, the forces at play behind some pretty dramatic market moves.
Yeah, buckle up.
We've got a stack of reports from MarketWatch, The Wall Street Journal, and Bloomberg.
Sounds like a good mix.
And let me tell you, there are some surprises in here, from plunging currencies and soaring bond yields to the AI chip race heating up, and even some potential relief for those burdened with medical debt.
Yeah, it's fascinating how these seemingly disparate events are actually all intertwined.
Yeah.
Painting a picture of a global economy that is definitely in flux.
It is. Okay, so let's dive right in with MarketWatch's article on the UK.
The UK?
The pound is taking a tumble and borrowing costs for the UK government are skyrocketing.
Oh, boy.
We're talking levels not seen since the 2008 financial crisis.
Yeah,
That's got to have some folks worried, right?
it's definitely a cause for concern. I mean, the article points to something called bond vigilantes.
Bond vigil.
Yeah, essentially, these are fixed income traders who start selling off government bonds when they lose faith in a government's ability to manage its finances.
I see.
And this sell-off drives yields up, effectively increasing the cost of borrowing for the government.
So it's like they're saying, we don't trust you to handle our money.
Exactly.
But why is this happening specifically in the UK? The article mentions a stagflationary cycle. Can you explain that in plain English?
Sure. Stagflation is essentially a nasty combination of slow economic growth, stagnation,
Okay.
coupled with high inflation. The UK economy is unfortunately facing both right now.
Right.
And this puts a real strain on government revenue and makes it harder to manage debt.
I see.
And this, in turn, makes those bond vigilantes we were talking about nervous,
Yeah.
leading to the sell-off that we're seeing.
Makes sense. And to make matters worse, a weaker pound makes imports more expensive, further fueling inflation.
Right, it's a vicious cycle.
Yeah. The article also mentioned that the U.S. actually has a higher debt-to-GDP ratio than the U.K.
Interesting.
Does that mean we could be the bond vigilantes' next target?
It's a possibility, and one that savvy investors are surely watching closely. I mean, the U.S. debt situation has been a growing concern for some time now.
Yeah.
And if the market senses a lack of fiscal discipline from the government, we could see a similar reaction here.
Oh, wow.
Yeah.
This situation really highlights how interconnected global markets are.
Yeah.
Economic tremors in one region
Right.
can quickly send shockwaves across the globe.
That's a sobering thought.
It is.
Okay, let's shift gears to the tech world. The Wall Street Journal's Tech Media and Telecom Roundup had an interesting piece about the race for AI chips.
Okay.
They focused on ASML, holding a Dutch company that makes semiconductor equipment.
Semiconductor equipment.
Yeah, sounds pretty niche.
It does.
But they're apparently a major player in this whole AI game.
They are indeed. What's fascinating about ASML is they hold a near monopoly on a critical piece of equipment that's used to manufacture the most advanced chips. Without ASML's technology, companies like NVIDIA, which dominates the AI chip market, can't produce their cutting-edge processors.
So ASML is essentially the gatekeeper to AI advancement.
You could say that.
That's incredible power for one company to hold.
It is.
The article mentioned that analysts have kind of mixed feelings about ASML's future, though.
Mixed feelings.
They're expecting somewhat muted growth in 2025,
Okay.
but also suggest that withholding quarterly order figures might make the company more appealing to investors in the long run.
Interesting strategy. What do you think about that?
What do I think?
That
I don't know. It's a tough one.
It's a calculated risk, I think. By moving away from quarterly reporting, ASML is trying to signal to investors that they're focused on the long game,
Yeah.
on steady, sustainable growth,
Right.
rather than chasing short-term gains.
Yeah.
This could attract investors who are looking for stability, especially in a sector as volatile as tech.
It's like they're saying, don't sweat the small stuff, focus on the big picture.
Exactly.
I get it. Speaking of volatility, another MarketWatch article caught my eye. This one was titled, Wall Street's Riskiest Stocks Are Melting Down as Retail Traders Face Day of Reckoning.
Oh, boy.
They're talking quantum computing stocks, nuclear power plays, even those meme stocks are getting dragged into the mess.
It's a mess.
What exactly is going on here?
This article highlights the inherent dangers of speculative investing.
Okay.
These high-flying stocks, often favored by retail traders, are susceptible to wild price swings,
Right.
especially when driven by hype rather than solid fundamentals.
It's like a game of musical chairs where someone is always left holding the bag when the music stops.
A perfect analogy.
What triggered this sudden meltdown?
Well, the article points to a comment from NVIDIA's CEO Jensen Huang
Okay.
about the timeline for quantum computers.
Uh-huh.
He suggested that truly useful quantum computers could still be 2 decades away.
Really?
This seemingly innocuous remark sent shockwaves through the market, particularly among investors who were betting on a much faster arrival of this technology.
So a dose of reality from the CEO of a leading tech company spooked the market.
You could say that.
That's wild. And it looks like the panic selling spread beyond quantum computing stocks, hitting other speculative favorites.
Absolutely. We saw a similar pattern during the meme stock frenzy of 2021
Oh, yeah?
with stocks like GameStop and AMC.
Right.
When investors get caught up in the hype, they often fail to fully grasp the risks involved.
Yeah.
And when the tide turns, as it inevitably does, panic selling can lead to a domino effect across different assets.
That's why it's so important to do your research
Absolutely.
and understand what you're investing in.
For sure.
It's easy to get caught up in the excitement, but it's crucial to remember that markets can be irrational in the short term.
Very true.
A well-diversified portfolio and a long-term investment strategy are key to navigating these fluctuations.
I couldn't agree more. Don't chase those shiny objects.
Right.
Okay, let's shift gears again. We've talked about market turmoil, but there's a glimmer of hope for those struggling with medical debt. MarketWatch has an article on a new rule from the Biden administration that aims to protect consumers from the crushing weight of medical debt.
This is definitely something a lot of people are dealing with.
It is.
So what's the gist of this new rule?
Essentially, the Consumer Financial Protection Bureau is removing unpaid medical debt from credit reports.
Wow.
This is a huge win for consumers because it means that unpaid medical bills will no longer drag down their credit scores,
Okay.
making it easier to access loans and other financial products.
That sounds like a game changer for people facing unexpected medical expenses.
It is a big deal.
But the article also mentioned some pushback from industry groups.
There's always pushback.
What are their concerns?
Some credit reporting agencies and financial institutions argue that medical debt provides a more complete picture of a consumer's debt profile
Okay.
and is necessary for lenders to assess creditworthiness.
I see.
They've even filed lawsuits claiming that the CFPB has overstepped its authority.
So even with a rule designed to protect consumers, there's a legal battle brewing.
It wouldn't be the financial world without a legal battle.
That's true. What's interesting is that the article also pointed out a broader trend of hospitals and medical providers choosing not to report this type of debt to credit agencies in the first place.
Really?
They're recognizing that medical debt is often unavoidable
Yeah.
and doesn't necessarily reflect a person's overall financial responsibility.
It's a positive shift in perspective.
It is. However, for those currently facing medical debt, the article offered some helpful tips.
Oh, that's good. What did they suggest?
Firstly, avoid putting medical debt on credit cards if at all possible.
Car.
This converts it into financial debt and strips away certain protections.
Right.
Instead, try negotiating with providers for payment plans or financial assistance.
Good advice.
Many are willing to work with patients facing difficult circumstances.
I hope so.
It's a good reminder that you have more power than you might think in these situations.
Knowledge is power.
And as the article pointed out, it's crucial to stay informed about state and local regulations regarding medical debt, because some areas offer additional protections.
Always good to know your rights.
Exactly. All right, let's head back to Europe for our final story in this segment. Bloomberg reported that Polish energy group Orlen is boosting its dividends in a new 2035 plan.
Dividends.
It seems like they're trying to woo investors back after a lackluster year. That's their strategy. From what I gathered, Orlen is making a massive investment in cleaner energy sources.
Oh, wow.
Upwards of $91 billion over the next decade.
That's a lot of money.
They're looking at gas production, offshore wind farms, and even exploring small nuclear reactors.
That's a bold move.
It is, and it signals a significant commitment to the clean energy transition.
It does.
However, the article also mentioned that their shares actually dipped after this announcement.
Dipped.
Why would that be?
Good question.
Yeah, that was my question, too. It seems like investors are wary of the sheer scale of the proposed expenditures. There are concerns about potential impacts on profitability and whether Orlen can actually achieve these ambitious targets.
It's understandable that investors would be cautious. This is a massive undertaking,
Right.
and it will require significant resources and careful execution.
So it's a gamble, but one that could pay off big time if they succeed.
Definitely.
It'll be interesting to see how this unfolds.
It will. Orlen is betting big on the future of clean energy.
Yeah.
And the market's reaction shows that investors are still assessing the potential risks and rewards.
This has already been a jam-packed deep dive, and we've only just scratched the surface of these stories.
We have.
I'm eager to delve deeper into some of these topics.
Right, too.
What's next on our agenda?
Well, let's take a quick break, and then we'll be back with more insights from the financial headlines.
Sounds good.
Welcome back to part 2 of our deep dive, where we're going to continue exploring these market trends and uncover what they might mean for you.
You know, as we were discussing that last story about Orlen's big clean energy gamble, it made me think about the overall stock market and whether we're setting ourselves up for another bubble. I mean, Bloomberg had this article, the stock market is at the same valuation as when Greenspan made his irrational exuberance comment that really caught my attention.
It's definitely a comparison that should give investors pause. Back in 1996, when Alan Greenspan, the former Fed chair, first uttered those famous words, irrational exuberance,
Right.
the stock market was experiencing a period of rapid growth fueled by the dot-com boom. Sound familiar?
It does.
The article points out that we're currently at a similar valuation level today, and surging bond yields are playing a big role in this comparison.
So are rising bond yields a red flag for stocks? I'm not totally clear on the connection.
Think of it this way. When bond yields go up, it makes bonds relatively more attractive to investors compared to stocks.
Okay,
This can pull money out of the stock market, putting downward pressure on equity valuations.
I see.
Essentially, investors start to question whether stock prices are justified given the potential returns they could get from less risky investments like bonds.
Okay, that makes sense. And the article quoted a Goldman Sachs strategist who suggested that stocks are priced for perfection right now. What does that mean exactly?
It means the market is assuming a best-case scenario, continued economic growth, low inflation, and no major surprises.
Right.
But as we've learned time and time again, the market can be incredibly unpredictable. Any unexpected event, a geopolitical crisis, a resurgence of inflation, you name it, could shatter that perfection and trigger a correction.
So are we headed for another dot-com bubble burst?
It's impossible to say for sure. However, the article's analysis, coupled with the current economic climate, does raise some valid concerns.
Yeah.
It's a reminder that investors need to be cautious and not get swept up in market euphoria. Diversification and a long-term investment strategy remain the most prudent approach.
Well, that's not exactly the optimistic news I was hoping for, but it's definitely a reality check. Speaking of market indicators, that MarketWatch article about the January effect got me thinking. They mentioned a bunch of different indicators, like the Santa Claus rally, the first 5 days indicator, and the January barometer. It seems like they're sending mixed signals this year.
Yes, these popular market indicators don't always paint a clear picture. For those who might not be familiar, let me quickly explain what each one represents.
Okay.
The Santa Claus rally tracks stock market performance during the last 5 trading days of December and the first 2 of January. This year, it didn't really materialize. The first 5 days indicator simply looks at the market's performance during the first 5 trading days of January, which happened to be positive this year.
Okay.
And lastly, the January barometer, arguably the most significant of the 3, takes into account the entire month's performance.
So which one should we pay more attention to?
The article highlights the historical significance of the January barometer. It suggests that when the January barometer is positive, regardless of the other 2 indicators, the S&P 500 tends to have a good year.
Interesting.
So we need to wait and see how the rest of the month plays out before drawing any conclusions about the year ahead.
It sounds like these indicators are more like guidelines than hard and fast rules. We can't rely solely on them to predict the future of the market, right?
Exactly. They can offer some insights into historical patterns and investor sentiment, but countless other factors can influence stock prices.
Right.
It's crucial to consider the broader economic context, geopolitical events, and individual company performance as well.
You know, while we're on the topic of specific companies, I wanted to circle back to the Wall Street Journal's Energy and Utilities Roundup.
Okay.
They had that piece on Orlen's dividend boost plans, the same Polish energy company we were just discussing.
Yeah.
They're pledging to increase dividends and pour billions into cleaner energy sources over the next decade. It's a bold strategy, but is it a smart one?
It's a fascinating case study in balancing shareholder interests with long-term sustainability. On the one hand, increasing dividends can attract investors and boost share prices.
Yeah.
On the other hand, pouring billions into cleaner energy is a long-term bet that may not yield immediate returns. The article mentioned gas production as part of their investment plan, which might seem contradictory to their clean energy goals.
Right. It seems like they're trying to hedge their bets by investing in both traditional and renewable energy sources.
Exactly. They're acknowledging the realities of the current energy landscape while also positioning themselves for a future where clean energy dominates.
Mhm.
It's a delicate balancing act, and only time will tell if it will pay off.
The Bloomberg piece we discussed earlier mentioned that Orland's shares actually dipped after this announcement. It seems like investors aren't entirely convinced.
That's right. Some analysts are concerned about the sheer scale of the planned investments and whether Orlen can achieve its ambitious targets without compromising profitability.
Yeah.
It's a gamble, no doubt about it. But it's also a testament to the growing pressure on energy companies to transition to cleaner sources.
Speaking of pressure and competition, let's swing back to the tech world. MarketWatch had a concerning article about Advanced Micro Devices, or AMD, as they try to compete with the behemoth that is NVIDIA in the AI chip market.
Oh, AMD.
The title alone, Can AMD Gain Ground on NVIDIA? This new bear sees a tough road ahead. Doesn't sound very promising.
It doesn't, does it? The article paints a rather bleak picture for AMD's prospects in this particular market.
Yeah.
NVIDIA's GPU technology is considered the gold standard for AI applications, and AMD is struggling to catch up in terms of performance and market share.
It sounds like a classic David versus Goliath scenario.
Yeah.
What are some of the key obstacles AMD is facing?
The article highlights several challenges, including the sheer dominance of NVIDIA's technology, the increasing competition from other chip makers like Marvell Technology and Broadcom, and the potential threat of Amazon Web Services developing its own custom-designed chips.
Wow.
It's a crowded and fiercely competitive landscape.
So it's not just NVIDIA that AMD needs to worry about.
Not at all. The AI chip market is attracting players from all corners of the tech industry. And while AMD does have other business segments, like their client business, which includes PC processors, the article suggests that growth in these areas is unlikely to offset the challenges they're facing in AI.
So even though AMD isn't solely focused on AI, their struggles in that market could have significant implications for their overall business.
Precisely. This highlights the importance of diversification and adaptation in the tech industry.
Yeah.
Companies that fail to innovate and keep pace with rapidly evolving technologies risk being left behind.
This deep dive is really highlighting how interconnected these different sectors of the global economy are. One story seems to inevitably bleed into the next.
Welcome back to the final part of our deep dive. It's remarkable how these global financial trends are all playing out on the same stage.
It really is. You know, with all this talk about stock market valuations and potential bubbles, I started thinking about safe haven assets like gold. I was looking at CNBC's article, Gold Retreats, focused on U.S. data for cues on Federal Reserve's policy path, and it seems like gold prices are pulling back after a recent surge. What's driving this shift?
The article points to a couple of factors at play. Firstly, some investors are likely cashing in on recent gains, taking profits while they can.
Right.
But the bigger driver seems to be uncertainty surrounding the Federal Reserve's next move on interest rates.
Right. Gold is often seen as a hedge against inflation and economic uncertainty. But when interest rates are high holding, gold becomes less appealing because it doesn't generate any yield.
Exactly. Investors are currently in a wait-and-see mode, looking for signals from the Fed about the future direction of interest rates. The upcoming U.S. jobs report could provide some clues about the strength of the economy, which could influence the Fed's decision-making.
So all eyes on the jobs report. That makes sense.
Okay.
Okay, let's shift gears from precious metals to consumer goods. CNBC's European Markets Live Updates had some interesting retail news, starting with Marks & Spencer. Their latest trading statement showed strong performance in their food division, but their stock price still dipped. What gives?
It's a classic case of investors looking beyond the immediate numbers. While Marks & Spencer's food sales were positive, it seems that investors are more concerned about the broader economic headwinds facing the retail sector.
Okay.
There's a lot of uncertainty about consumer spending in the coming months, and that's weighing on investor sentiment.
So even a good earnings report isn't enough to instill confidence when there are worries about the bigger economic picture. Speaking of broader economic concerns, the CNBC Live blog also highlighted some troubling data coming out of China. Apparently, consumer price inflation slowed significantly in December, fueling fears of deflation.
That's right. Deflation can be a dangerous spiral because it can lead to falling prices, reduced spending, and ultimately economic stagnation.
What's driving this deflationary trend in China?
Several factors are contributing, including weak consumer demand, an oversupply of goods in certain sectors, and a global economic slowdown. It's a complex mix of internal and external pressures.
And this trend in China could have implications for the global economy as a whole, right?
Absolutely. China is a major player on the world stage, and its economic health impacts everyone. A slowdown in China could ripple outwards, affecting global trade and growth.
It's a stark reminder that we're all interconnected in this global financial ecosystem. It's been quite a journey today, from plunging currencies and soaring bond yields to the AI chip race, medical debt relief, and even the potential for deflation in China. We've covered a lot of ground in this deep dive.
We have, and it's amazing to see how these seemingly disparate events are all connected, painting a complex and ever-changing picture of the global financial landscape.
As we wrap up this deep dive, one question that emerges is this. With so much change afoot in the energy sector and the rise of AI potentially upending other industries as well, what overlooked investment opportunities are lurking beneath the surface? That's something for you to ponder as you navigate these market shifts.
It's an excellent question. Amidst all this volatility and uncertainty, there are always opportunities for those who are willing to do their research and look beyond the headlines.
That's some great food for thought. Well, that's all for today's deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.